All right, let's talk about one of the most powerful and maybe misunderstood forces in business today, venture capital. This is the engine behind so many of the tech giants we use every single day. So today, we're going to pull back the curtain and see exactly how it all works.
So let me ask you something. Think about companies like Airbnb, the one that completely changed how we all travel. Or Stripe, the company that basically powers online payments for half the internet. And of course, Dropbox, the OG of cloud storage. What do all three of them have in common?
You guessed it. They were all fueled by venture capital. VC funding was the rocket fuel that took them from just a cool idea in a garage to, a global powerhouse. And that's what we're digging into today, how that rocket fuel actually gets made.
Okay, so every huge company you can think of started with a spark, right? That one brilliant idea. But here's the thing, an idea on its own doesn't really do much. It needs resources, it needs cash to catch fire and actually grow into something real. And that is where the whole venture capital journey kicks off.
So what is venture capital, really? At its heart, it's a high-stakes deal. You've got investors, we call them VCs, and they give a bunch of money to young companies that they think could be huge. But here's the key difference. It's not a loan. They don't want you to pay it back. Instead, they take equity, a piece of the company. It's a massive, massive bet on what that company could become. Right, so if VC money is the fuel, then the venture capital firm itself, well, that's the engine. It's a pretty complex machine with a ton of moving parts. So let's pop the hood and see how this whole money machine actually runs. Okay, to understand this, you really need to know the three main players in the game. First up, you've got the limited partners, or LPs. These are the folks with the really deep pockets. Think pension funds, big university endowments. They're the ones who actually provide the money. Then you have the general partners, or GPs. These are the actual VCs. Their job is to take that big pile of money and find the most brilliant startups to invest it in. And of course, you have the founders, the entrepreneurs with the big idea who get the cash to try and build their dream.
And the whole process follows a pretty predictable path. First, the GPs, the VCs, go out and raise a giant fund from their LPs. Step 2, they start hunting for the most promising startups out there. Once they find one they like, they do a ton of homework on it. That's called due diligence. If everything checks out, they invest, trading their cash for a slice of the company, maybe 10 to 30%. But they don't just disappear. They stick around, offering advice and connections to help it grow. And the end game? It's all about the exit. That's either the company going public with an IPO or getting bought by a bigger company. That's how everyone, hopefully, gets their money back, plus a whole lot more. All right, so once a VC decides they want in, we get to the most critical part of this whole thing, making the deal. This is where the lawyers get involved. It's a high-stakes negotiation where all the details get hammered out. And believe me, for both the founder and the VC, pretty much everything is on the line right here. And the absolute cornerstone of that deal is something called the valuation. Basically, it's the price tag they agree to put on the company. And it's not really based on how much money the company is making right now, but on how huge it could be in the future. That number, the valuation, is what decides how much a single share is worth.
And what are the VCs actually buying with all that cash? They're buying equity. It's that simple. They're trading their money for a percentage of ownership. So for a founder, this is a huge moment. You're literally selling a piece of your dream to get the fuel you need to make it a reality.
Now, selling that equity leads to something called dilution. It sounds kind of scary, but here's how it works. Every time you take more money from new investors, more shares get created. That means your personal ownership percentage goes down. It's the classic founder's paradox, right? The whole goal is to end up owning a smaller slice of a pie that's become 1,000 times bigger. So you can see this as a huge trade-off. On one hand, the pros are incredible, right? You get a massive injection of cash, expert advice, and a huge credibility boost. But the cons are just as real. You're giving up a chunk of your company, you lose some control, and suddenly you're under intense pressure to grow fast. It is absolutely not the right path for every company or every founder. And that pressure for insane growth, that brings us to the brutal reality of the VC world. You have to stop thinking of it like a bank. It's much, much more like a high-stakes casino. The investors are placing huge bets, all of them hoping to find that one unicorn, the next billion-dollar company. And they go in knowing that most of their bets are going to come up snake eyes. And just look at the numbers. They are stark. Over 70% of startups that take venture capital money ultimately fail. They just burn through all the cash, and poof, they're gone. And the crazy part is, this isn't seen as a mistake. It's a built-in feature of the model.
The risk is just baked right in. So you're probably asking, how on earth do these firms stay in business if most of their companies fail? Well, the answer is a concept called the power law. See, a VC fund doesn't need 10 small wins. They need one massive, out-of-the-park home run. That one single unicorn can bring in so much money that it pays for all the failures and then some. It makes the entire fund profitable.
And when I say home run, I mean legendary. Just look at Excel Partners' early bet on Facebook. They put in about $12.7 million. You want to know what they got back? An estimated $9 billion. Or how about Sequoia and WhatsApp? They invested around $60 million and got back $3 billion. That's the power law in action, right there.
Okay, so knowing the odds are so ridiculously stacked against you, how does a founder even get a foot in the door? How do you possibly convince these VCs that your company is that next unicorn they're looking for? Well, it all boils down to the pitch. VCs are hunting for a very specific checklist of things. First and foremost, the team. You'll hear them say, "We bet on the jockey, not the horse." They want resilient, smart founders. Next, the market has to be huge and growing. The product needs to solve a real, painful problem for a lot of people. But maybe most importantly, they need to see traction, some proof, like early users or revenue, that this thing is actually working. And the final, ultimate question is always, can this company give us that 10x or even 100x return we need for our fund to work?
But we have to be honest here. Getting that pitch heard is not a level playing field, not even close. The VC industry faces some really serious criticism. For one, there's a major lack of diversity. The money overwhelmingly flows to a very specific, narrow group of people. There's also the problem of short-term thinking, where the intense pressure for hypergrowth can actually destroy good companies. And yeah, the whole Silicon Valley bubble is real. Great ideas from other parts of the world often get completely overlooked. And this quote really nails the core philosophy of the whole industry. Venture capital is not about financing failure, but it is about taking risks. Some of those risks will result in failure. See, the whole model is built on accepting that failure is just part of the game. It's a necessary cost in the high-stakes hunt for those few truly world-changing companies that make it all worthwhile. So there you have it, the world of venture capital. It's an incredibly powerful engine, but it's really built for one very specific type of company, one that's aiming for massive global scale. And that leaves us with a really important final question to think about. If VC is just one kind of rocket fuel, what other kinds of fuel are out there for founders who want to build a different kind of company?